Welcome to another tutorial video. As you can see, we are going to go through a full three-statement model starting from a blank Excel sheet here. This will be in the format of a 90-minute case study, which you can review in the Word document here. I'll show you where all these documents and the links are, but essentially here, we are going to start with very much a blank Excel sheet. And by the end, we're going to get something that looks like this, which is a finished version of this that I completed myself in about 75 minutes. Before jumping into Excel though, let's just say a few words about this and the motivation for adding this tutorial. So a common critique of our training is that we always tend to start with templates for the financial models. And so people often write to us and say, what about starting without a template? What about if you just had to start from a blank sheet? Because if you start with a template, everything looks a bit too easy. All the data and formatting are in place. And yes, it takes some time and effort to create the forecasts and link in all the formulas, but a lot of it is already done for you with a template. And my response to this is that there is value in learning how to start from scratch, but the problem is that it takes much longer to teach because of the data entry and formatting. Both of these are very boring for the most part. The other issue is that in real life, yes, sometimes you will get case studies where you have to do them from scratch, but in other cases, banks, private equity firms, even hedge funds will give you case studies where they have some type of template, either partial or full, and then you just have to complete it. And then even when you're working on models on the job, you're not really going to be building them from scratch in most cases. You're usually going to be starting with some type of basis or existing version that you need to modify. Nevertheless, since there is value in teaching you how to do it from scratch, we are going to cover that here. I'm going to warn you in advance that I will be using a few custom shortcuts via the quick access toolbar in Excel and a simple macro or two to complete this exercise and save a bit of time. Nothing too complicated, but just a few things that save a few minutes here and there. You will need to be very quick with Excel to follow along. If you don't know the shortcuts very well, you are not going to be able to come close to completing this case study in the 90 minutes allotted here. So if that's you, you will probably have to slow down or rewind certain parts or rewatch them and go at a slower pace. If you want to get all the files and resources here, go to mergersandinquisitions.com/3-statement-model. So just go there or search for Mergers Inquisitions 3-statement model on Google and you will get to this page. We have everything there, the Excel files, the PDFs, the blank version, and the completed version as well. Let's get started with a quick overview of 3-statement modeling tests and why banks and other finance firms give you them. The idea here is that you take a company's historical income statement, balance sheet, and cash flow statement, and then you project them over usually a 5-year period. So in this case, for this company, Otis, we would go to their 10K and we would go down to where they have the financial statements and supplementary data. And then we would either go through the PDF format of this and copy and paste it in from here, which is not very efficient, or we would bring up the Excel or CSV version and use that one. And we would paste in these financials and then we'd create projections to see what they look like over the next 5 years from 2022 to 2026. You do this because you want to determine whether the company's projected growth in margins and free cash flow and other metrics are actually realistic. For example, maybe the company says something like, we'll generate $5 billion of free cash flow and then use it to repay $1 billion of debt and then return $4 billion to shareholders in the form of dividends and share repurchases. If you build a proper 3-statement model, you can assess whether that's realistic, whether the company might actually need outside funding, whether it's not in fact going to generate this much in free cash flow. And you also can tell what happens if market conditions change or if the company's business takes a turn for the worse, for example. Now, in terms of the types of 3-statement modeling tests, the first category here is when you have a blank sheet and a strict time limit, like 30 minutes, 60 minutes, 90 minutes, 2 hours, maybe even up to 3 or 4 hours. These tests are more about working quickly, knowing Excel shortcuts very well, simplifying, and then making quick decisions under pressure and not overthinking what to do. Now, another category here is when you have a template and also a strict time limit. So they might give you a partially complete version that has all the data filled in, but then you have to make the projections. In this case, it's more about entering the correct formulas, justifying your assumptions, and then you often have to answer questions based on the model's output here because you don't have to do all the data entry, which sometimes frees up 30 minutes, 40 minutes, even 60 minutes. And then the last category is when there is no strict time limit. So maybe you have a couple days or a week, but you're not talking about 60 minutes or 2 hours. In this case, it's much more about doing some outside research and using the data to justify your assumptions for the revenue, expense, and cash flow projections, you will often make some type of presentation at the end. So you're not necessarily just answering questions, you're actually making a presentation to the firm or the group you're interviewing with at the end as well. This is going to be a very long tutorial because it is a 90-minute case study, and so I'm going to give you the timestamps for everything right here. We'll start by inputting the historical financial statements for this company, Otis. Then we will go through the income statement projections, then the balance sheet projections, and then the cash flow statement projections. Then we will link the financial statements, and then we will look at one last part here, one part that's a little bit more difficult, which is figuring out what to do with the company's debt and also how to treat their stock repurchases in this model. And then in the last part, we will do some model checks. We'll do a quick review and give some final comments on what we did well and then what could also use improvement in this model. Let's get started with the first part and go to the financial statement input here. I recommend taking a quick look at the case study document, this 90-minute case study for Otis. They're not really telling us exactly what to do. They're just saying we have 90 minutes and we need to create 5-year projections. They're saying we need to do something a little bit more complex for revenue than a simple percentage growth rate. They're giving us a minimum cash balance. They're saying that we need to look up the company's guidance for things like acquisitions and debt and dividends and stock repurchases. Don't worry too much about the formatting, and then make sure that we can evaluate some of the company's claims with our model. When you start this and you have to input the financial statements, you could, in theory, try to copy and paste everything over from this PDF, but the much better alternative is to get this in Excel or CSV format if it's at all possible. It's going to save you a huge amount of time because they break out everything here, and you can't necessarily just copy and paste everything exactly as they have it, but it's still going to save you a lot of time if you have it in this format. And if you go over here, go to the operations tab, you have to press Control and page down a bunch of times to go over to this. But if you go over here, you can see their income statement, what they call the consolidated statement of operations, and we'll be able to just link to these directly and then copy and paste them into our spreadsheet, or just add links and then copy and paste them as values later on. A few tips for this part include the fact that you always want to start with the company's financials in Excel or CSV format, swap the columns around so they go from oldest to newest. Use positives for revenue and income on the income statement and negatives for everything else. It'll be much easier to sum up everything and check your work that way. You also want to consolidate the smaller line items as much as possible, or you're going to waste time on the projections later. So if a company has a couple different categories for operating expenses, but some of them are smaller as they are here, let's just bring this up and I'll go up a few pages. So here, yes, they have these two categories, research and development and selling, general, and administrative, but research and development is very small, so we would just consolidate these because R&D is not significant enough to be broken out separately. Let's now go in and demonstrate how to do this. I'm going to bring up the blank file right here. I always like to start by removing grid lines, so Alt-WVG, and then I like to change the column width on the side to 2 so that we have this one sort of blank column over here. It makes it easier to jump around later. And I will start by inputting the income statement up here. I also want to change the font size to 12 everywhere, so I'll do that right now. We can also see that we are very clearly going to start this in fiscal 2019. So let's add some more space here, and then let's start inputting these dates. So December 31st, 2019, and then we'll use the EO month function in Excel to go forward 12 months, and then another 12 months. I'll copy and paste all these formats. And I'm just increasing the column widths there. It's a little bit cumbersome to look at this with the full dates. So one thing I like to do is to go to Format Cells with Control-1 and then Custom, and then for type, we can enter FY for fiscal year and then YY for the year itself. We have that. With that set up, let's take a look at the underlying data now. This setup doesn't really make sense because you don't want to go from newest to oldest. You want to go from oldest to newest. So let's delete these columns in the middle right here. It also looks like Excel has merged some cells, which we do not like. So I'm going to undo the cell merge, and this will make it easier to copy and paste these columns around as well. And then let's get started doing that. So I'll put the 2021 column here, the 2019 column over here, and then I'll delete these 2 extra columns. In terms of revenue, we have products, services, and then we have the cost of goods sold by product and services. We have operating expenses, and then we have some other smaller line items. For some reason, they're putting other income and expense within the operating expenses here, but we're probably going to change that. And then we have some standard line items as we go down. So let's do the same thing here and undo the merge of cells because I find it quite annoying to work with. And let's go ahead and start entering this. So products, services, total revenue, and then cost of products, cost of services, operating expenses. This will be our combined line item for the SG&A and the R&D. And then we'll have operating income down here. And then we'll have other income / expense. And then going over here, so we have interest income, and then we have the non-service pension cost. So we have a couple different components here, these two, and then this other income / expense that I'm just moving down here. So I'll say non-service pension expense. This is another form of interest effectively, and then interest income / expense right here. And then we'll have the pre-tax income, income taxes, and then at the bottom we have the net income. And then we also have something for the non-controlling interest. So I'll just abbreviate this as NCI, net income, and then I'll say net income to parent. And I'm just doing some indents right here to separate these from the rest. And we should add some underlines here as well. So in my version of Excel, I can go to Alt-7 and just go to top border because I've set up that specific keyboard shortcut. If you didn't have this, you could just go to Control-1 and border and set it up like that. It doesn't really matter, but I find Alt-7 to be a little bit faster for doing this type of thing. Let's resize this column again. And now let's start linking this in directly. So let's go over here, and I'm going to remove the anchor here because we do want this to shift around. So I pressed F4 a few times so that the dollar signs are no longer around this in Excel. And let's do this and then sum these up. Cost of products and cost of services. So here, you have to be careful because they're listing these with positive signs. We don't like that. We think it's better to list actual expenses with all negative signs. It's easier to check your model like that as well. So let's do this for both of these. And then for the operating expenses here, we want to sum up the R&D and the SG&A. And then we'll copy this over and sum these up. And then here, we'll go to accounting and we'll change it to no decimal places. And we'll do the same thing right here. So we have that. And then for other income / expense, let's go down and get these from right here. Non-service pension costs, we'll get it from right here. And then we'll go down one lower for the interest income / expense. Let's copy down our formatting once again to save a bit of time. For the income taxes, let's go and get this number from here. They're listing it with a positive, which again, we don't like. So we're going to put a negative sign in front of this to flip it around. And then here, okay, I messed up with the net income and also the operating income. What we should be doing is taking revenue and then adding up all of these negative expenses to get the operating income. And then here for the pre-tax income, we want the operating income, and then we'll add up all the expenses here. Net income will be pre-tax income minus the taxes. And then for the non-controlling interest net income, they have it listed down at the bottom right here, and they're subtracting it, but for some reason they're showing it with a positive, which again, we want to change in our version of this. So for this one, let's go in and link to the non-controlling interest net income. We have that, and then we'll put in the top border right there and sum these up, and then let's copy this across so we have that. Now, one thing you want to do before you move on is go back and look at the file here and see what they have for net income and then what we have. So it looks like our net income numbers do not actually match theirs. They're getting 1,420 in the last year. We're getting 1,714. And if we go in and look at this quickly, it looks like the issue here is that the pre-tax income doesn't appear to match. So the net income before income taxes here doesn't seem to be matching up with theirs. Other income seems to have the right sign because they're showing positives with positives and negatives with negatives. The non-service pension cost / benefit seems to have the reverse sign. So let's go in and fix that up. And then the interest income / expense also seems to have the reverse sign. So let's go in and fix this and see if this works. And now the net income here seems to match up with the numbers that they have. Now at this point, you could do a couple things. You could go in and you could add some more formatting, such as $signs here at the top and at the bottom. That would be fine. You could also go in and break all the links and just do copy and paste as values to remove the links like that. But since we're still working on this model, I don't think it's a great use of time to do it at this stage. What I want to do instead is move to the next part, the balance sheet, and show you how to input that. And then once we're done inputting all the statements, we'll go back and do some type of final check right here. I'll also just change the alignment of these. I'm using my Alt-5 shortcut to put these in the center. Let's now go down and I'll start entering the balance sheet right here. And then we'll link to our dates up here at the top. So we have them here, and I probably should have linked in the formatting as well. So we have that. And then let's go to the Excel file and see where we can get the balance sheet from. So we'll go past the comprehensive income one, and then here we have the balance sheet. So on the balance sheet, I have some tips on the slides, but in general, you want to aim for about 5 items on each side. It can be slightly higher for some companies, but you normally don't want to go above 10 items on the asset side or more than 10 on the liabilities and equity side, or the projections are going to be much more complicated. So we're going to keep in mind that guidance here. Once again, we need to unmerge a lot of these cells. I don't know why companies do it, but it makes it very, very annoying to actually input all this in Excel. So let's do this quickly. And then let's just cut and paste these columns and rearrange them a little bit. And then here, let's change the spacing and make sure that the first one here starts in column C so that it actually matches up with what we're doing. So in terms of what to consolidate here, I would put cash and restricted cash together. I would leave accounts receivable separate, but I would probably put the contract assets, the inventory, and the other current assets together. And then going down to the long-term assets. So here, I would probably group together the fixed assets, the PP&E, with the intangibles and the goodwill. And the reason I'm suggesting that is because if you look at the cash flow statement, the company doesn't actually give separate line items for depreciation and amortization. So in other words, they're listing both of these together, which means that it's going to be very difficult to create separate links here for the intangibles versus the net PP&E. So we probably want to consolidate these a little bit. Operating lease assets, these future income tax benefits, and then other assets. We can probably consolidate some or all of these. I would probably leave operating lease assets here separate because you project it in somewhat of a different way than the others. But let's go in and start doing this. So I'm going to start with assets right here. And then we'll say cash, accounts receivable, inventory, and other, since we're consolidating that one. And then net PP&E, goodwill, and intangibles, since we're consolidating all of those. Operating lease assets, I do think is worth showing separately. And then other assets down here. And then we'll have total assets at the bottom. And then for the formatting here, let's just copy it from above where we have it right here. And I'll just indent these a little bit with Alt H6. So for the cash, let's go in and sum up the first 2 lines, the cash and then the restricted cash. We're going to count both of them. For the accounts receivable, this is just the next line. And then these 3 line items, remember, we're consolidating contract assets, inventory, and other current assets. They're all very small, and they're probably going to follow about the same trends. We're also consolidating PP&E, goodwill, and intangibles. So let's take the fixed assets right there. That's PP&E. We'll take the intangible assets right there, and then we'll take the goodwill right there. And we have that. And then the operating lease assets we're going to show separately. Let's do that. And then for other assets, we'll take the future income tax benefits and then the other assets down here. We'll add these up, and then we get to the same number that they do for the total assets. Let's also go in and fix up some of the formatting here a little bit. I just want to be able to put something like a $sign up at the very top. Not really a big deal, but we'd like to have it if we can. The other issue here is that if you go back and look at the raw file, they're actually not giving us the 2019 numbers. They're only giving us the 2020 and 2021 numbers. So let's actually go back to our file right here and just cut and paste this over to the side. And then we can copy this across and see that we get the same number for total assets for the next year as well. And it seems like our numbers do not actually match theirs exactly. So we've probably messed up a sign or the anchoring somewhere. It looks like accounts receivable, I accidentally anchored that, but I shouldn't have. $12,279. Now our numbers match. Now on the liabilities and equity side, there are some obvious ones to consolidate, like the short-term debt right there and the long-term debt. We don't want to list those separately. And then we have some others like the future income tax obligations, other long-term liabilities, pension and post-retirement obligations. A lot of these we should probably also consolidate. And then moving down here, we're not going to show the components of shareholders' equity separately. It's a waste of time. The non-controlling interest is worth showing separately because the projections will work a little bit differently for it. But frankly, you can actually simplify this as well if you're really pressed for time. You don't need to show it as a separate line item here. I would probably leave these working capital line items, accounts payable, accrued liabilities, and contract liabilities as separate for now because they're all fairly significant. So let's go in and start entering some of this now. I'm going to call this liabilities and equity, and then we'll have accounts payable, accrued liabilities, contract liabilities, total debt, operating lease liabilities, and then other liabilities down here, and then total liabilities at the bottom. And then for the equity section, as I said, we're going to consolidate everything in common shareholders' equity. And then we have the non-controlling interest below this. And together, these will give us the total equity. And then at the very bottom, we'll have total liabilities plus equity. And we want to do a balance sheet check to make sure that the asset side equals the liabilities plus equity side. So let's get started linking these in. For accounts payable, let's go over to our raw file right here, and we'll link to it right here. I'll remove the anchoring, and the first three line items can just be direct links all right here. So pretty simple there. For total debt, we need to go and get the short-term borrowings, and then we also want to bring in the long-term debt in the section right below that. For operating lease liabilities, we are going to show this one separately because it needs to be matched with the operating lease assets. And then for other liabilities, so for this one, let's go in and we're going to include the pension and retirement obligations here, the future income tax obligations, and then the other long-term liabilities. These are all smaller line items that tend not to matter as much, so I am just consolidating them right here. It seems like our total liabilities for the first year do add up and match theirs, 13,911, so that is a good first sign. Let's copy this over. And let's also copy down some of the formatting here. The second year also matches up. Moving on to the common shareholders' equity now. So we'll link to their total shareholders' equity or deficit down here. We have that. And then for the non-controlling interest, we actually have this line item called a redeemable non-controlling interest. We're not really sure what this is for now, but we need to include it somewhere on the balance sheet. So we'll link to this and then the actual non-controlling interest right below it. So we have that, and then we can add these up and copy it across, and I'll fix up the formatting here once again. And then let's do a summation of our total liabilities and our total equity down here. Also remove the dollar signs in this section. And then let's do a balance sheet check. So total assets minus total liabilities and equity. And it seems like our balance sheet, at least in these two historical years, does indeed balance correctly. Now at this stage, I'm also going to go in and apply some formatting here. I'm using Alt-6 in my version of Excel, but you could go to just Control-1 and change the background color as well. So I'm going to add some headers here, not because we really have to, but because it does help to set these apart, especially as we keep inputting and adding more financial statements below this. So let's go on now to the next financial statement, the cash flow statement. If you go to the raw file and you go to the cash flows tab, you'll see everything right here. The first thing I want to do, as always, is remove all of these annoying merged cells. So let's go in and just unmerge all these and then do the same thing over here. Unfortunately, it's hard to select a large range here of merged cells. You normally have to go column by column or something like it to do this. And then let's go in and swap the column. So we'll put 2020 over here, Control X for 2021 and put it over here. And we have that. I'm also going to change the column width here and then delete all these columns. And this is looking better. We probably want one blank column here though, just so that when we link this in, there's no confusion, because C, D, and E should correspond to 2019, 2020, and 2021 in both versions. So they're starting with net income. They have depreciation and amortization. They have this deferred tax line item, stock-based compensation, gains and losses. They have the change in working capital here, pension contributions and other operating activities, and then they have CapEx, and then they have a few other line items down here related to investments and the proceeds from the sale of investments. And then down here, they have a bunch of line items related to the proceeds from debt and the issuances of debt, as well as the payment of debt issuance costs, the repayments of long-term debt, dividends, stock repurchases, and dividends to the non-controlling interest, and then a few other miscellaneous things like net transfers to some other division of the company here. There's a lot going on, and then to make things even more complicated, they also have some FX rate effects here at the bottom. So we have quite a bit to consolidate and simplify here. And my general guidance is that on the cash flow statement, you want to consolidate pretty much everything in cash flow from investing except for CapEx. Within cash flow from financing, you want to show the change in debt as a single line item and then have separate lines for dividends, stock issuances and repurchases, and then miscellaneous and other. So that's generally what we're going to follow right here. But let's go in and start entering the cash flow statement. I'm going to start by copying and pasting down the balance sheet, and I'm going to anchor these as well. And I should probably actually add the additional years here at the top so we don't have to do this later. So I'm just using the EO month function to go forward 12 months. And then here, let's go up and link to this, and then Alt-5 to center it. I'll copy this over, and then you could go in and just press F4 for each one to make sure it is anchored as you copy and paste this down. But let's take this whole balance sheet part right here and just copy and paste it down, and I'll say cash flow statement, and we have that. So let's start with cash flow from operations. Now I'm going to start this with net income to parent, because if you look at how we did this on the income statement, we actually deducted the non-controlling interest net income to get to net income to parent. So we're going to start with this, and then we'll reverse the net income to non-controlling interest in our version of this. I'll move this over a little bit. So the first thing we need to do is the reversal of NCI net income. This is pretty important because when this company owns over 50% but less than 100% of another company, it deducts that company's net income, but it's not actually a cash loss or a cash impact from the deduction. So we have to reverse it on the cash flow statement. We do need a line item here for depreciation and amortization. So I'll just label that D&A. And then we need something else here for all these other items. And I can just call this something like pensions/other items, because we're going to combine the pension contributions right there. And technically this could be a minus or a plus. And then if you look at the rest of the raw version here, I don't think it's really worth listing all these working capital line items separately, because they're really all showing the same thing, which is that as the company grows, it's either going to generate more cash flow than expected or less than expected based on the timing differences, how quickly it collects from customers, how quickly it pays suppliers, and so on. So I think we can consolidate all of these into one single line. And in fact, I'm just going to call this plus or minus the change in working capital and leases down here. And then I'll say cash flow from operations, and I'll add the top border right there. For cash flow from investing, as I said in the slide, you very rarely want to do anything super complicated here. So you can have CapEx, and then I would just simplify everything else. Unless the company is doing something very unusual, I would put everything else in this category, something like acquisitions and other, and then we can have cash flow from investing right here. And then for cash flow from financing, so we can say plus or minus the changes in debt, because we're going to consolidate everything that we saw, all the issuances, all the repayments, all in this one line item. We'll have something for the common dividends, because that is an important part of this case study. And then we'll have something for the stock purchases. They do have dividends to non-controlling interest if you go back and look at the file. So we do want to include that, because this line is going to end up playing into the non-controlling interest line item right here. And then we'll have something else here for kind of a catch-all for all these other miscellaneous items. And then I'll say cash flow from financing at the very bottom let's copy and paste our formatting down. And then let's do an indentation right here. So let's start this one by actually linking up to our income statement initially. And then we need to reverse the non-controlling interest net income that we deducted. So I'll do that and flip it with a negative sign. And then for these other items, now we can go into the raw version right here. And we'll go to the depreciation and amortization first. This one is fine as is. For the pensions and other items, this is going to be for basically everything else here other than the working capital. So we want the deferred income taxes. We want the stock-based compensation. We want the gains and losses because they're small and non-recurring, so we don't really care. We also want the pension contributions and the other operating activities down here. So we have that. And then for the change in working capital and leases, let's go over here and just add these all up. And we have that. And then we can get that. And let's make sure our numbers match theirs. They're saying 1,469, and it seems like our numbers do actually match in this case. Now moving down, for the CapEx, let's go over to the raw version once again, and we'll get it from right here. And then for everything else below this, so let's go in and just add up everything here. And it seems like it matches their number. And let's copy this across and see what happens. Negative 353, negative 89. So it seems like all of that is working so far. I just wanted to do this because in some of these we see this dash character, which sometimes causes an issue when you link to it and include it in formulas in Excel. But in this case, it seems to be working correctly. And then let's go to the cash flow from financing and go back to the raw file once again. So first we need to grab everything related to debt, which means that we need to take basically the top few line items in this section, the proceeds from issuance of long-term debt, and then the repayments of borrowings. So we have all those. I'm going to remove the anchors, and then we want the repayment of long-term debt right there. And it looks like that's actually about it. I'm going to count the payments of debt issuance costs as a separate line item here, so we're not including it at this stage. And we get a value error. So that's what I was afraid of. The issue here is that sometimes with these dash characters, you get this in Excel, and the fastest way to fix it is just to enter zeros here instead of dashes. And this should usually do the trick in a case like this. The same thing goes for dividends, repurchases of stock, net transfers. Basically anything that has a dash, you should probably just go in and replace with a zero to make it easier to copy and paste in like this. For the common dividends, this is listed right here. The stock repurchases should be right below it. And then for the dividends to non-controlling interests, they have it right here, dividends paid to non-controlling interests. And then other items will be everything else here. So we want the debt issuance costs in this line right here. And then we also want the net transfers to UTC, whatever that is, the financing, the other financing activities. So we have that. Let's add this up. So we do match their number of 1,133 right here. Let's also at this stage copy and paste down some of the formatting so this looks a bit better, and do the same thing for the cash flow from investing section. I also want the FX rate effects at the bottom because this is what we use to calculate at the end the net change in cash. And for the FX rate effects, if we go over here, this is this line, effect of foreign exchange rates on cash and cash equivalents. So let's just link that in. And then for the net change in cash, cash flow from operations, plus investing, plus financing, plus the FX rate effects. Let's now copy across everything that we have here and see what this looks like. And okay, so we have some issues. Let's see what happened here. It looks like we're getting the value error because of the same issue with the annoying dashes in these company formatted financials. So let's just put a 0 in right there. And this seems to be working now, but let's just check our work a little bit before proceeding because we want to make sure that we actually have the correct numbers here first. The easiest way to check this is to look at the net change in cash at the very bottom. And if this matches up, it's very likely that our input also matched up. So 113, it matches up. 342, let's check the raw file right here, 342, and then 1,676. This also seems to match up. So it seems like our net change in cash here does match up properly. It's not a guarantee that this is working, but with the strict time constraints here, I think it's a pretty good bet that all of this looks good. Technically, at this point, we might want to go in and break all these external links and just copy and paste everything as values, but I'm actually not going to worry about that for now, just because we are under such strict time pressure and we've already spent about 30 minutes just inputting and setting up the historical financial statements and doing some consolidation and simplification of these statements. So with all that said, let's now go to part 2 and look at the income statement projections. Now, the first thing to note here is that for the revenue, remember, they told us that we need something more than a simple percentage growth rate to project the company's revenue. If you look at the PDF, you could search through this for a while and you could look at something like the units sold, and you won't really find too much of anything. Also, it takes quite a long time to search such a long PDF, so I don't think this is a very useful strategy. What I'd say is a better idea than searching through the 10K is to actually look at the investor presentation that they gave us. And if you just flip through this quickly, you can try to get a sense of what data they're actually providing. The first couple slides here are kind of useless. They're saying right here that these sales are in millions of units. But the problem is that if you look closely, they're only giving us the numbers for every 4 years or so. So they're not giving us everything in between. Also, it's not clear if this is the overall market or just this company. So we might be able to use something like that, but we might not. So let's just keep looking. They're giving us some metrics on their on the units they're servicing, their revenue by product and service. And then again, they're giving us some information about the service segment right here. So this will be useful for when we actually have to project this, because they're saying they're going to go from 2.1 million units to 2.5 million at about a 3% annualized growth rate between now and 2026. They're giving us some information about the free cash flow conversion and the dividend payout ratio, which is good, but we're not going to use it right this second. And then they're giving us information about the medium-term outlook, but I'm just scrolling through here to see if we can get something better or more useful that we can use to project the company's revenue. We have the service units, so we could potentially use that, but we need something for the product segment right here. And here we have it. So right here, they're still only technically giving us the numbers for every 4 years, but the difference is on this graph, the market share graph, we can extrapolate and we can say it was 16% in 2019, 18% in 2021. It's safe to say it was probably around 17% in 2020. So that seems like a fairly safe guess from this. And based on this market share data, we can guess the total market size for the new equipment segment, and then we can make some projections based on that. So since we don't have real good unit by unit data, we're just going to use market share and market size here. This means that we won't be able to link the product and service revenue directly, but in this 90-minute case study, we just don't have time to dig in and look through every page of the 10K or find a way to fix this. With other items, we're just going to make them simple average percentages of revenue and extend them going forward. So things like the cost of goods sold and the operating expenses and even the tax rate will end up being very simple averages because we just don't really have time to do much of anything else here. So let's go back to our file and go up to the top, and I'm going to enter another area here for the drivers in the model. And I'll just call this one drivers. And what I'll say is new equipment market size. And then we can assume the market is growing at a certain rate. So I'll enter the growth rate. And then we can have the new equipment market share for our company right here. And if you go back and look, you'll remember that we had 16% in 2019, 18% in 2021. So let's go in and enter these numbers. 17% and then 18%. And I might as well color code these in blue. I've been sort of ignoring color coding so far, but it is helpful in the assumptions area just to distinguish historical numbers versus numbers that you're inputting. Now, we also know the company's product revenue in these years. So what we can do is take their product revenue and then divide by their market share to get the approximate market size right here. And then we can look at the growth rate of the market. And I'm just going to use Control-Shift percentage sign or Control-Shift 5 to enter it like that. I actually don't like that formatting too much, so let's go in and see if we can come up with something better. And I'm just going to enter it as a 0.0 percentage, semicolon, and then use parentheses 0.0 percentage to make that into what our negative here looks like. So unsurprisingly, the market fell by about 10% in 2020, and then it started growing again in 2021. If you look at the company's guidance here, and let's just go back to the beginning and do a search for growth or growth rate and see what they say about this. So we do have this growth rate for the services segment where they're giving us the number of elevator units they're servicing each year. And this is helpful for that segment, but we want something for the product segment as well. And they're giving us a little bit here, but we don't really want it by separate regions. We don't have time for separate regions in this case. And I keep scrolling through this to try to find something for the growth rate. Okay, so once again, they're giving us the annualized growth numbers for the service revenue. They're saying about $10 billion in service revenue by 2026, which is useful, again, but we want something for the product segment. Okay, if it's not turning up that way, let's just do a quick scroll through this and see what we can find looking through it quickly. Okay, so on this slide, 42 out of 56, they're giving us an estimate here. They're saying new equipment up to low single digits. Low single digits basically means 1% to 5%. Service up mid single digits probably is more like the 3% to 7% range. And then for the company overall, low to mid single digits. Hard to say exactly what that is, but we would expect maybe something like 3 to 5 or 6% overall. This is organic. They're also going to make acquisitions, so our growth rates here might be a little bit higher. Also, if we go back to the market share chart, we also need some idea of how their market share might change over time. So let's just go back there and scroll up a little bit. So it seems like they had this market share drop going into 2012, and then they've been gradually recovering over time, although not necessarily by a huge percentage. We're going to use all this to create our estimates right here. I will be fairly conservative and say it starts out growing at about 5% per year. And let's go in and I'll just add a decimal place. Actually add it to all these with my Alt-3 shortcut. If you don't have Alt-3, you can go to the home menu with Alt-H, and then you can add decimal places from here, Alt-H0 or Alt-H9. So I'll say 5% growth, 5% growth, 4%, 3%. It's roughly matching their estimates for the low single digit percentage growth, but we're looking at the overall market. I'll take this and multiply by these growth rates, and let's copy and paste this formatting and make sure this is the matching column width. Okay, let's fix these column widths as well. So 11.14, and that should be fine. Now for the market share, we could do this in a couple different ways, but what I'm gonna do here is just assume a gradual increase over time. So maybe going up by about 0.5% total over this whole period, 18%, 18.2%, 18.4%, 18.5%, 18.5%, maybe something like that. And with that, we can now project their product revenue. So it's just the market size times the market share. And we need to fix the formatting here before we attempt to copy all this across. I'm actually going to hold off on copying across the income statement itself right now because I want to set up all the drivers and assumptions first. Now, the other component here is the service revenue. As I showed you a few times in the investor presentation, they do actually give us some useful data on that. So let's go there and see what we can get. Okay, they're saying just over 2.1 million units as of 2021, and they're saying right around 2.1 million in 2020, and it looks like around 2 million in 2019. So let's go in and enter some of this. I'll say service units, and this is the maintenance segment. Effectively what happens is they sell these elevators and escalators, and then if companies want to keep them in service, they keep paying the company every year to come back and make repairs and do upgrades and updates and fixes and other things like that. I'll also have a growth rate here. And then we're probably going to project this on a revenue per service unit basis because we actually have the number of units that they're servicing each year. And then we have the growth rate down here. So I'll say 2, 2.1, and then maybe 2.15 if it's just over the 2.1 level here. I'm also going to format these in the blue color. And then here, I'll go in and I'll just use 2 decimal places for all of these. Now, for the growth rates, let's take some of our approach from up here, 5%, 2.4%. So it seems to be growing very modestly. They gave the number of 3% in the presentation. So I'll just take that 3% and copy it across. And then I'll take the old number, multiply by 1 plus the 3%. And then fix up the formatting there and copy this across. And then for the revenue per service unit, so this is how much each company that is having its unit serviced by Otis actually pays them each year on average. We'll take the service revenue here. This is in millions already. And then these units, if you look at the chart, these are also in millions already. So we can just do a simple division here. We don't need to multiply or divide by 1,000 or 1,000,000 or anything like that. And let's fix up the formatting on these. And then let's copy down the growth rates once again. So we're looking at pretty modest growth here, probably in line with overall GDP growth or the rate of inflation or something in that range. I'm going to start this at 4% and make it go to 3.5%, 3.5%, 3%, 3% by the end. And then we'll take this number, multiply by 1 plus the 4%, copy this across, and now we can get to their service revenue. So we'll take the service units and multiply by the revenue per service unit, add these up. And although I normally don't like to copy across the income statement until we're done with everything to save time, I will do it in this case because the company has given us some guidance. They said the service revenue should reach 10 billion by fiscal 2026. We get there a little bit earlier, but that's not necessarily a problem. And if we look at the other metrics and we just calculate the growth rates here, I would say these are reasonable. They did say low to mid single digit growth rates for the revenue here, and we're at between about 4% and 6 or 7%. Maybe we're a little bit on the high side, but we're also not splitting this into organic growth versus growth from acquisitions. So I think this is fine for a quick and simple model like this. With the revenue assumptions set up, the next thing is that we need to project the cost of goods sold, the operating expenses, and then some of these other line items. We also need the income taxes. Some of these line items like the non-service pension expense, we can probably keep about the same because they're so small to begin with. Let's go in and start with product, and we'll say COGS as a percent of revenue, and then we'll have service COGS as a percent of revenue, and then OPEX as a percent of revenue. We also need the tax rate, and then for the non-controlling interest net income, we need to look at this probably as a percent of the total net income down here, because when Otis owns over 50% of another company, they consolidate the financials 100%, and then they deduct the portion that is not attributable to them at the bottom. So it's going to be related and trend very closely with the overall net income here, the 100% consolidated version. So let's go in and take our product or cost of product as a percent of product revenue, then do the same thing for the cost of services down here. We'll take OPEX as a percent of total revenue as well. And then let's get our percentage format set up. Let's see what these look like. So these are very clearly in almost exactly the same range. There's no point doing anything here other than a simple average. So let's do that right now. I'll take an average for these. And then in the future periods, once you have the historical average, you don't want to keep averaging it. So in other words, you don't want to just copy it across like this because then your number keeps changing each year as you keep averaging subsequent years. What you want to do is get the average in this one column. You can even make it bold if you want, and then just link to this in each subsequent year, and we get to that. With the tax rate, it's the same idea. Let's go down and take the taxes and divide by the pre-tax income. And then for the net income to non-controlling interest, let's do something similar down here. And then let's see what these numbers look like. And these are all so close as well that we're going to take the same approach. Just take the simple average, copy it down like that. And then let's enter these figures right here. So products times COGS as a percent of products. Unsurprisingly, the products here cost a lot more in terms of the per unit manufacturing costs than the services do, as you'd expect. Physical products like this are almost always going to be more expensive on a per unit basis than services delivered. We'll copy down the formula for this one, and then for the operating expenses, total revenue times OPEX as a percent of revenue. Add these up, and I add them up the wrong way yet again. So we really want total revenue minus all these expenses. For other income / expense, this is so small that I would just take across the historical number and keep it constant. And same for the non-service pension expense. This is so small. It's tiny compared to everything else. It's not even worth spending 10 seconds, 30 seconds, or 60 seconds trying to project. Interest expense, we're going to leave blank for now and come back to. And then we'll copy across the pre-tax income formula, the income tax formula. Actually, we can't copy across the income tax formula because this is a direct link to another worksheet. But let's take the pre-tax income and multiply by the tax rate we have up here. And then let's get our non-controlling interest net income from right here. We have this, and now we'll copy that across so we have that set up. And so that's really it for our income statement projections. Let's go on to part 3, the balance sheet projections. With the working capital line items here, that's what we're going to focus on here. And we've been over this topic of working capital and the change in working capital many times in this channel. These items can be simple percentages of revenue, COGS, OPEX, or total expenses in any reasonable range, because what really matters here is not the exact number for accounts receivable, but whether the overall change in working capital continues to be positive as the company grows, or whether it stays negative as the company grows. And in the case of this particular company, if you just take a look at the financials, I think it's pretty clear that the overall change in working capital is generally positive for them. And you can go back further in the financials and see that it is negative in this 1 year, but for the most part, it seems like it's going to be positive for them. So let's go up and start projecting some of these line items. I'm going to add some rows here to just create some extra space. And then what I like to do in a case like this is open a notepad file, because we're going to need to copy and paste multiple things. So we want accounts receivable, we want inventory, operating lease assets will also be projected here. Other assets is probably going to flow in from the cash flow statement. Same for the PP&E, goodwill, and intangibles. Cash will flow in from the cash flow statement. But then these others, accounts payable, accrued liabilities, contract liabilities will all be projected here. Total debt will come from the cash flow statement. Operating lease liabilities will match the changes to the operating lease assets. And then other liabilities, we might as well project them here. We don't know exactly what else on the cash flow statement is going to link into them anyway. And then once I have all these saved in a text file like this, we can just paste them in right here. And you could add some separation if you want. So for example, you could just add a line here to separate the liabilities from the assets. And what I can now do is say that accounts receivable will be a % of revenue, inventory and other should be a % of COGS, as you'd expect. Operating lease assets should probably be linked to the operating expenses. And then accounts payable should probably be linked to COGS, although it could go either way. We don't really have time to dig into it and see what it consists of. Accrued liabilities will be a % of the total expenses, most likely. These could represent almost anything, ranging from the costs of actually manufacturing and delivering the physical products to the costs of running the office and the rent and the utilities. So we're going to link it to total expenses. And then contract liabilities, similarly, I think it's easiest just to link it to the total expenses here. And then other liabilities, we're going to do the same thing and link this to other expenses as well. We just don't have time to really get into it. We just want to make sure that overall the cash flow pattern here makes sense. So for accounts receivable, we don't have any of these for 2019. We need to go to 2020 to get these first. We'll take this and then go up here, and then inventory and other, we will link to the COGS right above it. For the operating lease assets as a % of OPEX. So let's go down here, and then we'll divide by the operating expenses right here. And then for accounts payable as a % of COGS, let's do this and divide by summation here, and then accrued liabilities. So we'll take this, and then we will divide by the total expenses right above. And I made a typo there, so let's fix that. Contract liabilities, it's pretty much the same idea. So let's just go here and then divide by our total expenses right there. And then other liabilities, take this and divide by the total expenses as well. So you have all these, and I'm going to copy and paste down the formatting here to save a bit of time. One of the issues here is that we only have 2 years of data. And with only 2 years of data, it's really difficult to say what the trends here actually are. I don't think you can really say much of anything with the amount of information that we actually have here. And so I think the safest thing to do for all of these is to take the same approach and use a simple average, carry that average across, and use it to project everything in our model. So let's just do that right now. I'll copy and paste this down. And technically, we are averaging column C as well, but if you think about how this works, it shouldn't matter, because when we have a blank cell here that doesn't have anything in it, Excel simply doesn't count it in the formula. So we don't actually need to do anything different here. Let's go down now and start filling these in. Also, when we're done with this, I will look at the change in working capital and leases on the cash flow statement to make sure our estimates are reasonable. Let's get our revenue first, and we'll multiply by the accounts receivable as a percent of revenue. And then for the COGS, let's go up and get the total COGS right here and multiply by this percentage. For the operating lease assets, let's go and get our operating expenses and then multiply by the percentage right here. And then on the other side, for accounts payable, this is also linked to COGS. So let's sum up the two COGS line items and then multiply by this. And then for accrued liabilities. So here, let's take these line items and I'll actually anchor the 40 through 42 parts because we don't want these to shift down as we copy and paste this formula down. So let's take this and multiply by the accrued liabilities as a percent of total expenses right there. Copy down for the contract liabilities. And then for other liabilities, we need to tweak this formula a little bit and go up 2 rows to F29 instead. So we have that. All this is in place. Let's now take this and just copy and paste this to the right so we can fix up the formatting a little bit. The other thing I want to do is factor in the operating lease liabilities. How we usually project these for US GAAP-based companies is to take the old number and then whatever change took place on the asset side here, we replicate on the liability side to simplify things. So if the operating lease assets went up as they do here, we just take this change and we add it to the operating lease liabilities on this side. And that's the simplest way to do this. Under IFRS, it gets more complicated, but for US-based companies, it's fine. The accounting treatment is a little bit simpler, so you can do something very easy like this. Also at this stage, I want to go in and fill in the change in working capital and leases to make sure that this stays in a positive range over time. So let's take on the asset side the old number and subtract the new number. And we'll do this for each line item here. We're doing this because when an asset goes up, something like inventory is the easiest example to think of. It means the company has spent cash to increase it. When a liability goes up, something like accounts payable, it means the company's cash flow goes up because they've recorded an expense, but they haven't actually paid it in cash yet. And then let's go down and get everything down here. So on the liability side, we're going to take the new versions and subtract the old versions. And then do the same thing right here. So overall, it seems like we're maybe a little bit high in the first year, but everything after that, I would say is in a reasonable range. We're a little bit on the high side, but it's not like we go up to 500 million or down to negative 300 million or anything like that. So I'd say this is probably good enough for our work, although obviously if we had more time and more data, we would refine this further. That's about all we have to project on the balance sheet for now. So let's go to the cash flow statement in this next part. Once again, I have some tips in slide format here. Most items are going to be either a simple percentage of revenue or they're just going to be blank for now because we need more information. For example, for things like the debt issuances and stock repurchases, we can't really say too much at the moment because we need to finish more of the model first. With the pensions, we're simplifying these and we're consolidating the pension contributions with the other smaller line items because they're very small. Pension assets and liabilities are sometimes worth showing separately, but in this case, they're relatively small and it gets very complicated to model these the right way. So we're just going to do it the fast way and consolidate it and not really pay much attention to these. The non-controlling interest also takes more time to model if you want to do it correctly, but we're not doing it correctly here. We're about finishing quickly. So we're going to simplify and make many of these line items simple reversals and percentages of the totals instead. So let's go up to our drivers and start inputting some of this information. On the cash flow statement, the first two items that you normally want to think about are the capital expenditures, which is usually going to be a percent of revenue if you don't have better information. Here, we would ideally like to link this to the amount of units the company sells or even the units they service or something like that, but there's just no time and we can't really get this information easily. We then want to look at D&A as a percent of revenue and make sure it stays in a reasonable range. And then looking down at the rest of the statement, pensions and other items, I'd say could also be a simple percent of revenue. Acquisitions and other is an item that we'll have to project in some way. And then all these other line items, I'll put them in my notepad file for now, just so we don't forget about them. But let's go up and start pasting these in and see what we can actually project for now and what's going to require some additional work here. So let's put some of these items up here in sort of the same area. And then let's try to divide this a little bit and see what we can actually project for now. So acquisitions and other, I think we can actually project. So we are going to do it in this section. The change in debt, we cannot project for now. So I'm going to leave this without any bold. Common dividends is just going to be a percent of net income. So I think we can easily project this for now. Make this a percent of net income. Stock repurchases is going to require some more effort, so I'm going to leave this out for now. And dividends to non-controlling interest can just be a percent of the non-controlling interest net income to really simplify things. Other items here, I'm going to leave this alone for now. FX rate effects can be a percent of revenue. Other items I'm leaving alone for now because if you look at it historically, it seems to be related to the company's debt issuances. The issuance fees were one of the line items we consolidated, so we're going to need to get some more information on the company's debt before we can link in this other items line. But let's start with the easier parts here. CapEx is a percent of revenue. Let's go down and take this, and then we'll divide by the revenue right up here. And let's copy and paste down our formats for this whole section as well. And then D&A as a percent of revenue. We actually don't need a negative sign for. So let's go down and take this and then divide by the revenue right up here. Pensions and other items. So I didn't actually say what this should be, but as expected, it's also going to be a percent of revenue. It's relatively small to begin with. Acquisitions and other. So this one is interesting because we don't know exactly how to project it for right now. However, if you go to the investor presentation for this one, and you just scroll toward the end where they give some of their expectations or what they expect to spend in different areas in the future. If we just scroll down a little bit more here, and I'm doing this because it's very slow to search this PDF, which is one downside of setting up the case study this way. So right here, they're saying that their bolt-on M&A is going to be $50 to $100 million annually. We can take the middle of that range. They're giving us the dividend payout ratio here of 35 to 40% as well. And then they're saying that the excess cash will be spent on share repurchases and targeted M&A. They even give us this nice chart here of what they're spending on acquisitions versus dividends versus share repurchases. So we have a lot of information from all of this. What I can say based on all that is that these acquisitions are probably going to be around 75 million per year. So I'll enter this as a negative 75 and just copy this over. And let's get the formatting for this as well. So we have that. Now for the common dividends, let's just abbreviate this to dividends as a percent of net income. We'll go down and take it from the bottom of the cash flow statement. And then we'll just divide by net income to parent. I don't think it really matters too much. And once again, I should apply this formatting to more of these areas. And then here, to avoid confusion, I should just call this NCI dividends instead. While we're down here, let's actually get this line item as well. So the non-controlling interest dividends right here, we'll use a negative sign and divide by the NCI net income up here. And then for FX rate effects, we can just take this raw number at the bottom and then divide by revenue. It's very small to begin with, but we do want to factor in something for this because the company does operate internationally. So with all that set up, let's copy across some of these numbers and see what we get to for these. Once again, these numbers vary so little. These numbers are so close together that for the most part, we are just going to take averages here and call it at that. We just don't really have time to investigate or do much else. So I'll take averages for CapEx, for D&A, and then for pensions and other items. I will also do the same thing for the NCI dividends as a percent of the NCI net income. So about 100% of this gets paid out. And then for the FX rate effects as a percent of revenue, same thing. This is so small, it's showing up as 0.0%. The one item here that is worth differentiating is the dividends as a percent of the net income. I'm fixing this because I accidentally labeled it net income instead. With this one, they told us specifically in the presentation that it's going to be a 35 to 40% payout ratio here. So I will reflect that, and I'll start this at 35%. I'll make it go up to 37.5% and then 40% in the years after this. And I will change the color coding here to blue to reflect that. And actually, I should have changed the first one to blue as well. So I'll fix that right now. With the acquisitions, same idea. This first one should be in blue, although the color coding here doesn't really matter because we're going so quickly. So with these set up, let's now go down and start linking in more of the cash flow statement right here. I'm going to start by linking to the net income to parent from the income statement. We already have reversed the NCI net income, so we can link that over. For the DNA, we need to link to the revenue right here and then multiply by our percentage right up here. Let's also at this time copy across all the formatting so we don't have any mistakes or problems with that. For the pensions and other items, so this one is going to be a percent of revenue. Take this and multiply by the percentage right here. And then we have that. And then for the CapEx, so we will take the revenue and then multiply by CapEx as a percent of revenue right there. For the acquisitions and other, so we're just going to do a direct link to it right here. Sum these up. Change in debt we'll leave blank for now. Common dividends we can actually calculate. So let's get our net income to parent and multiply by the 35% to 40% right there. Stock repurchases we'll leave blank for now. Dividends to non-controlling interest. So we have the net income to non-controlling interest. Let's take this and multiply by the percentage right here. And then for the FX rate effects, let's go up and take the revenue and multiply by this. And then net change in cash. We already have it from the historical year, so let's just copy across this formula. We'll copy across the cash flow from financing as well. And then let's copy across this whole thing. So I'm just doing this and then Control R to copy this across. So we have that. So we have an outline of our cash flow statement, but we have some issues because we still have to link everything on the balance sheet and make sure that the balance sheet balances. Also, we have another problem, which is that we haven't projected the change in debt yet. We don't have the stock repurchases, and we don't have these other line items. So there are definitely some gaps here, but we are also approaching the finish line for this case study. Let's go to the next part here, which is linking the statements. The first thing I'll say here is that if you're new to this process, you want to check off items or highlight lines as you move along to avoid errors. I'm not going to do that necessarily for everything, but if we run into a problem or we've forgotten something, we might use this to go back and fix it. Cash should always flow in based on the old balance plus the net change on the cash flow statement. So let's go and take the old number right here, and then it'll just add the net change in cash from the cash flow statement, and we can copy this across. The net PP&E, goodwill, and intangibles, which we've combined here, these are just going to be linked to CapEx and D&A. We're going to subtract both of these. On the asset side of the balance sheet, where you're linking to the cash flow statement, you always subtract line items. So we take this and we're subtracting CapEx here because when the company spends on CapEx, it increases its net PP&E. We're subtracting the positive D&A here because when there's depreciation and amortization, the PP&E and intangibles, the book values of them both go down. Copy this over. Other assets. We want to subtract acquisitions and then pensions and other. We don't know where else to put these, and we've consolidated so many things in here. The pension assets are listed here. We're going to take this number and then subtract pensions and other items, and then acquisitions and other. And then before copying this across, let's just add this up and copy across total assets. So we have that. Now, moving to the other side of the balance sheet, total debt, we want to link to the change in debt and the old balance. So let's take the old balance and then go down and link to the change in debt right here. And we can copy this across. And this is actually all we have on the liabilities side that has not been linked, so we can add these all up. For the operating lease liabilities, we actually did this before. I forgot that I structured this a little bit differently, but it's just the old number, and then we factor in however the operating lease assets changed. It does get more complicated than this in real life, but if you have 90 minutes to do this and it's a frantic rush to finish, you can't really worry about any of that. So the best thing is to simplify, make the operating lease assets a simple percent of expenses or OPEX or something like that, and continue with it. And then for the non-controlling interest here, it's going to be the old number plus the non-controlling interest net income plus the non-controlling interest dividends. So we have both these on the cash flow statement. And then common shareholders' equity is going to be the old number plus the net income to the parent. the dividends, the stock repurchases, other items, and then FX rate effects. It's essentially a catch-all for everything that doesn't link to any other specific line item on the balance sheet. So if you look at the cash flow statement, for example, and you've checked off many of these items, but then you have some like the stock repurchases and the FX rate effects that have not yet linked to anything on the balance sheet, common shareholders' equity can be a catch-all for these, and it can link to these unmatched items. So we'll take this, we will link to the net income to parent, and then we have linked in all these other line items or otherwise reflected them on the balance sheet. We've linked CapEx, acquisitions, and other. Change in debt, we've already linked. Common dividends, we want to link in. Stock repurchases, other items, and then FX rate effects. So the moment of truth, let's add up everything and see if our balance sheet actually balances. And it does, or at least it does in this first year. We'll copy this across, and we have that. So we have a balanced balance sheet, but we still have a few items to figure out, like the change in debt and the stock repurchases and a few others like that. So let's now go to part 6, the debt and stock repurchases. So the first thing you have to decide on here is what your constants are going to be and what your variables are going to be. And I think the easiest way to do it in this case is that since the company gives us the specific dividend payout ratio, we know that they're going to have excess cash flow because they say it repeatedly. It seems to be true in past years. We can assume that a portion of this goes to debt repayment and a portion goes to the stock repurchases and the targeted M&A. We already know some of it goes to the common stock dividends. With the debt repayment and the stock repurchases and targeted M&A, you could do this in different ways. Looking at this looks like maybe an 80-20 split, maybe an 85-15 split, something like that. We also know from the case study document that the minimum cash is $3 billion in the future years here, in the projected years. So what we can do is factor in all that and then calculate if the company has excess cash flow in the period shown. If it does, then it can repurchase stock and repay debt. Let's go in and start setting this up. The first thing I'm going to do is add some rows here and say the minimum cash. Then we need to calculate the excess cash flow. And then we need to say that some of it will go to stock repurchases and some will go to debt repayment. Now the minimum cash, the case study gave us the answer. They said $3 billion. We're showing this as 3,000, but the units are in millions, so I think you get the idea. For the excess cash flow, what we have to do here is go to the previous cash balance in fiscal 2021, and then we have to add up everything on the cash flow statement except for the line items we're trying to calculate. So cash flow from operations, cash flow from investing. We also want to factor in the dividends to non-controlling interests, and then the FX rate effects down here. I'm not going to include these other items because as you'll see, they're going to be zero in many of these years. And if we factor them in like this, it's going to create a circular reference later on, which we want to avoid. So I'm just factoring in the items that we've actually projected right now and using this to figure out if we actually have an excess cash flow or a cash flow deficit here. So we have all these, and then we also want to subtract the minimum cash balance right here. And I'm going to anchor this so it doesn't shift as we move it across. And so it appears that in pretty much every single year here, we have excess cash flow. For the change in debt then, what I can say is if our excess cash flow is less than zero, so if we actually have a cash flow deficit and we need more, then we need to issue more debt that is equal to that amount. Otherwise, we can just take this amount right here and we can assume some debt repayment with it instead. And I'll multiply by the debt repayment percentage right here, which I haven't actually defined yet, but we'll get to that. Let's enter this. I'll say 15% for the debt repayment and 85% for the stock repurchases. It would be nice to have actual numbers here, but I can just eyeball it in the absence of those actual numbers. And let's just copy this across. So now we have our change in debt down here. And then for the stock repurchases, it's going to be very similar. So I can just say that if the change in debt here is less than zero, meaning that we actually repay debt, then we are going to take the excess cash flow right here and multiply by the stock repurchases. So we have that. And now I can copy this across. I can also delete this extra row right here, which we don't really need. Now, one other line item here that we've been ignoring is this other items. I'm going to assume that this is what the company uses to pay for the debt issuance fees. So I'll make this a percent of the debt issuances. And the problem here is that since we consolidated so many other line items in it, the numbers are kind of nonsensical for the 2019 and 2020 years. But for 2021, I think it's fine, and we can use this to get a rough sense of the percentage. So let's go down and take this number, and then we'll just divide by the total change in debt. So it looks to be about 3%. I'm just going to go with 2% for this one going forward. So I'll say 2% and keep it that way in each period. With these assumptions set up, let's now go down and link these to the cash flow statement. So first we need the change in debt. So I'll go up and take it from right here. Then we need the stock repurchases. So I'll go up and link in this one. And then for the other items. So with this one, if the change in debt is positive, meaning that the company needs to actually issue additional debt, then we'll want something here for it. Otherwise, we're not going to have anything because they don't pay any issuance fees when they're repaying debt. I can actually just use a max 0 function here and put it at the change in debt, because the max between a 0 and a negative is 0. The max between a positive and a 0 is a positive. And then we'll multiply by the 2% up here. And let's take this and copy these across. And so we have that. Moving up, it seems like our balance sheet is still balanced. And so there's really just one item here left, which is the interest income or interest expense. So here, we could do this in a couple different ways. I could go up and add this line for interest expense percent debt. We could project it like that. So let's go in and take the interest expense right here, and let's multiply by the debt balance this year, or we could take the previous year's debt balance. I don't think it really matters too much, but since we only have 2 years of data, let's take the interest expense and then divide by this year's total debt balance. So it seems to be around 2%. What is it going to be going forward? As you know, this was a period of rising interest rates as of the time I'm completing this case study. So it's safe to say that these interest rates are going to rise by at least a modest amount in the future. If you want to get a quick estimate, you could go back to the PDF version of the 10K and you could look at something like the long-term debt and do a quick search for that and see if you can find anything. And as you scroll through these results, actually on page 38 here, the first result I found, they're giving us an idea of when all their different debt balances are due. And I think the main takeaway from this is that most of their debt is not due until very far into the future, 2027, 2030, 2040, 2031. These years are all quite far away. And there is some that matures in 2026 or 2023, but overall, even if interest rates are going to go up from 0% to 5%, 6%, something like that, so much of their debt is already locked in and is at these low rates until very far into the future that we don't think this company's rates are really going to increase by all that much. So I'm going to go back here and I'll assume a modest increase instead. So maybe the rates are not going to double exactly or go up to 6 or 7%, but maybe they'll go up to 2.5%, 3%, 3%, maybe 3.5% by the end to reflect the fact that, yes, when the debt matures and they replace it with new debt, the rates are probably going to be higher, but the overall average rate on the entire balance is still not going to be all that high. And then to calculate this now and complete our income statement, let's take the interest expense as a percent of debt. I'm going to multiply it by the debt in the previous year just to avoid a possible circular reference here, which we don't want in these models. There's a very small difference. Taking the average here versus the previous year's balance is basically the same, especially with very, very low interest rates, but we're doing it this way just to avoid a potential circular reference. And so with that, we're done. So I have some additional notes here about how this logic works, where the company has to issue additional debt if it has a cash flow deficit, and if it has a cash flow surplus, it repays some debt and repurchases stock. And then we also divided up the stock repurchases and debt repayments by simple percentages. Let's now go to part 7 and talk about the model checks and the final comments here. So I think the biggest problem here, besides the overall bad formatting, is the fact that it's not a very robust model that'll support different cases easily. We should really project down to units sold and link items like CapEx to the productive capacity so we can separate the units sold from the average price per unit. So really, I think the biggest problem with this model going up here is the fact that we did not go down to units for many of these. We didn't go down to the level of individual employees and linking the number of employees to the units produced and shipped and serviced. In a more complex model, or one where they gave us a template or more information, or where we had several hours to do research, we might do something like that, but that's about the best we can do with the strict time limit here. The service revenue would be better to project if we assumed some type of renewal rate here rather than making it a very simple percentage growth rate. We'd want to link this to the number of units sold so that the new equipment would flow directly into the service units. But again, we just didn't have time for this. We'd probably need another 30 or 60 minutes to dig around for the data and do that. In terms of the goals here, in the investor presentation, they say $5 billion of cumulative free cash flow between 2022 and 2024. If we look at our model, let's just go down, and free cash flow is usually defined as cash flow from operations minus CapEx, or sometimes minus the entire cash flow from investing section. We get to about $5.2 billion in free cash flow. So it matches their number pretty closely. And we don't think their estimate is wrong or completely off base. If we look at the total amount of dividends here, for example, yes, the $1.4 billion is a pretty good percentage. It's about 1/3 or so of the $5 billion that they estimate. So it seems to match up with their expectations. The free cash flow conversion is defined in a bit of a weird way, but if you go down and look at it and look at the footnote, you actually have to go in the appendix here, but they're defining it as free cash flow divided by net income. If we go in and do it this way in ours, so cash flow from operations minus cash flow from investing divided by net income or net income to parent. Indeed, it does seem to be well over 100% in every single period here. And even historically, it was around 110% to 133% in these past few years. So this seems to be a reasonable goal as well. The growth rates, as we mentioned before, might be a bit on the high side. I'm not going to show this again, but you'll recall that when we calculated it here, the revenue growth was somewhere in the 4% to 7% range. It might be a little bit on the high side, so that's one to watch out for, but it's not completely off base. It's not as if we assumed 15% or -5% revenue growth. The company also mentions margin improvements if you look through its presentation, but we haven't assumed any of that. Also, our growth rates here are not organic. Ours assume that these acquisitions will proceed and will probably influence the revenue in some way. So we're a little bit high on the growth side, but overall, we think the company's plan is reasonable if the next 5 years are anything like the previous 3 years. So that's it for this case study. We are now at around the 90-minute mark, but we've accomplished our goal. We've finished this model in 90 minutes and we've met the requirements above, and our model can at least verify or examine some of the company's claims. So we started out by inputting the historical financial statements, and I showed you some tips to consolidate the statements and rearrange the company's internal financials more efficiently. Then we went to the income statement projections, and I showed you how to come up with some numbers for the market share and the units for the services segment, and how to make the rest very simple percentages. The balance sheet projections for working capital were also fairly simple. Most items are simple percentages of revenue, COGS, or OPEX. And then the cash flow statement projections, most of these, like CapEx and D&A, can be simple percentages of revenue as well. We then linked the statements, and you saw how each item, such as the cash and the common shareholders' equity, depends on the previous number, plus whatever changes and new line items take place in this period. And anything that was not projected directly on the balance sheet took the old line item and then factored in changes and line items from the cash flow statement. Then we went through this exercise for the debt and stock repurchases. The company uses any excess cash flow it has to repay debt and to repurchase stock. If it runs into a deficit, then it has to issue additional debt instead. And then we made some final comments on the model at the end. We did a quick review and made some comments there. Overall, now you should have a much better idea of how to do this. I know I went through this very quickly, and yes, it's going to be challenging if you don't know how to use Excel very well already, but that's kind of the point of this case study. You need to get to a certain level of Excel proficiency, and you need to be comfortable working under poor conditions with limited data and extreme time pressure if you want to succeed in these case studies, in interviews, and in this industry in general.